The Fed cuts. Where does it go from here? Welcome to Market Insight. I'm David Pollard. A first rate cut in more than 4 years marks a historic turning point into an easing cycle, with inflation finally seen as benign enough to provide room for that decision. But what sort of signal does today's decision send on the outlook for the economy? And what does that mean for the outlook for further rate cuts down the road? Well, let's get a view from First American Chief Economist Mark Fleming. Welcome, Mark. 50 basis points today. What are the key parameters that went into that decision and what swung it in favour of 50 rather than 25 basis points?
Yeah, the market was actually expecting 50, even more so yesterday. They, were a little less certain about it this morning, but the expectation was essentially met at 50 basis points. I think largely driven by the potential of future softening in the labor market in particular, as viewed by the Fed. But either way, I'm more concerned about the idea that we just starting the cycle. It's going to take a couple of years to get back to what the Fed expects to be the long run rate of Fed policy. And I'm just happy that we're now moving in that direction instead of the tightening cycle that we've been experiencing for the last 2 years.
So should we be celebrating that from over 9% in June of 2022 to 2.5% last month, the Fed has now got inflation beaten, or could inflation still fight back?
Well, there's always the risk that inflation could fight back and rear its ugly head again. I think part of the reason why we're not talking about huge rate cuts really quickly is that idea that we want to sort of keep some tightness, even though it's a little looser. There's still some restriction in monetary policy, and that it will take some time to do it. But it's all good news. I mean, 9% was pretty bad. Closer to 2 is better. We still have a little bit further to go. And most of that is actually being driven by persistent high shelter inflation at the moment.
Let's look a little more closely at the economy through the optics of the consumer and the labour market. Retail sales, they unexpectedly rose in August, according to Tuesday's data, as in fact did industrial production. But US payrolls increased less than expected in August. What's your analysis of all that data? Are there pockets of worry there for the Fed?
I think when it comes to the consumer, it's less about what is the inflation rate, whether it was 9 or 2. It's just what is the cost of living, and that has gone up. We're not talking about deflation, and so even though the pace of increasing cost of living has slowed down, the cost of living is still significantly higher, and that certainly weighs heavily on the consumer, and the U.S. economy is heavily predicated on consumption spending by that consumer. So this is a challenge and a risk that the Fed has to watch closely going forward.
And how will the US election, now not so far away, play into the policy outlook? Are markets overcooking their expectations for more rate cuts soon, given the political uncertainty?
Well, there have been some studies that have looked into sort of the effect of elections on financial markets and the economy writ large, and they've all sort of come to the same conclusion that there really is no effect in the immediate term of an election. So I don't know that the market's necessarily going to be making any decisions based upon, well, what is turning out to be probably a flip coin call on the election, and focusing more on the fundamentals in the economic data.
Now, you're a housing specialist. Single-family home building was up a pretty impressive 15.8% in August, according to today's data, and mortgage rates have been easing. We have more data later in the week. What's it likely to show, and is rising new supply still a worry for builders?
Yeah, the good news is, as we started at the beginning, any rate relief in the housing market is good relief, and we'll take every little bit of it. It certainly helps with the existing side of the market and increased inventory. That essentially creates more sort of competition for the new market. Essentially, an existing home and a new home are somewhat substitute goods. So I think the times of being the only provider of new supply, if you will, in the new housing market, that will be less so. But more broadly, we've not built enough houses in this country for over a decade. So any existing or new home will likely be snapped up in the future, regardless of rates and how much we build.
So broadly, one might argue that there's a more benign outlook across the whole of the US economy, but are the storm clouds still gathering on the horizon? Where are the key risks to the economy? Where are they likely to come from?
I think it comes from that consumer. We do see some increased distress amongst consumers. They've largely used all of the savings that was given to them during the pandemic stimulus. And there are rising rates of credit card delinquencies and car delinquencies, which are sort of early indicators of distress. But to be clear, rising off very, very low levels. But if there are storm clouds, I think it's in that consumer-facing distressed ability to afford the higher cost of living today in this country.
Okay, thank you, Mark Fleming of First American, for sharing those thoughts with us today. That is Market Insight. You can watch more videos on Reuters.com.